Happy Monday. Let's get back to business, gang, from the blockchain. Got a few different stories I want to show with you, a few different perspectives and insight, and my own personal opinion and take on some of these stories and the crypto market and traditional finance in general. So first, we're looking at the crypto market right now. As you can see, a lot of red. Things are on the downturn as of now. Am I worried? Absolutely not. I don't do the technical analysis that some people do, but I would suspect people that do would say something like the market's trying to find this bottom before it springs up to the top during this bull cycle. And I would agree. Because I've seen this before. This happens around the halving. This is something that I said would happen. The market typically does settle down, finds the bottom, and then we see a parabolic market uprising in prices. But as of now, we see Bitcoin is at 62,000, and the total market cap for cryptocurrency right now is 2.45 trillion, which is very good. So the metrics are good, the fundamentals are sound. And yeah, we'll probably see a recovery soon. I wouldn't panic. I mean, if anything, right now is a good time to double down on some of the coins that you believe in, some of the coins that you've researched and that you feel are going to do well. I base a lot of that on the kind of partnerships and developments that are going on, and also the sentiments on social media, how much, following they have, how much utility they have in the different categories of coins that I think will break out this year. Of course, nothing's guaranteed, but there's no reason for me to be panicking because the market is red. I don't expect that it would stay that way for too much longer. But let me get into some of the stories that I wanted to share. Some very interesting things that are going on. One of them being, as you can see right here on the screen for those that are watching, $10 billion bank shut down by U.S. regulators in first bank failure of 2024. So you remember last year we had 3 of the biggest bank collapse in history that happened. And now we have one for 2024. And these banks are falling for different reasons. To be honest with you, banks fall typically for the same reason FTX fell. That's why in the last video I did, I wasn't trying to cape. I wasn't trying to put on a cape and save Sam Bankman-Fried or excuse, him collapsing FTX. All I was saying is that banks do the same thing. They use your money. Remember, we're talking about a fractional reserve banking system is what we deal with. What that means is the banks only have to have a fraction of your reserves. So, for instance, if a bank has $10 billion of depositors' money, they only have to have $1 billion. And when I say $1 billion, I don't mean $1 billion cash in the bank. I mean they only have to have $1 billion on their accountant records. The rest could be in investments. The rest could be in loans. The rest could be in all kinds of different kind of things. That's just how the banking system operates here. But let's look into this particular bank. So U.S. regulators just announced the first bank failure of 2024. The FDIC says it stepped in to protect $6 billion in assets and $4 billion in customer deposits at Philadelphia-based Republic Bank. The assets will immediately be handed over to Fulton Bank, so it looks like another bank is taking over, a former rival that's also located in Philadelphia. Republic Bank's 32 branches in New Jersey, Pennsylvania, and New York will reopen as branches of Fulton Bank on Saturday for branches with normal Saturday hours or Monday during normal business hours. This evening and over the weekend, depositors of Republic Bank can access their money by writing checks or using ATM cards or debit cards. Checks drawn on Republic Bank will continue to be processed, and loan customers should continue to make their payments as usual. So, I mean, long story short, it doesn't really go into why the bank failed, but banks typically fall for the same reason. And that is too much output, not enough input. And like I said, because they are on a fractional reserve system. They do not have all the money. No bank does. That's just what it is. So the same reason FTX fails, the same reason banks fall, same practices are used in both. So there's that. We have the first bank failure of 2024. What does this really mean? Does it mean that, we are in an economic crisis? Probably. We're seeing fundamentally the breakdown of traditional finance. This is one of the reasons why crypto is seen, or blockchain and crypto is seen as a, I don't want to say threat. I think we use that too much, but it's a conflict of interest, to say the least. Like, the idea is, if people, right? If the majority of people, or enough people, seen the advantages and efficiency of blockchain crypto technology, right? Not to say that crypto is scalable for the masses as of now. Like 8 billion people switching to crypto overnight would crash the crypto system. It's not scalable like that. But the idea is this. Okay, I'll give you an example. So I have a Fidelity account for my 401k, some of my mutual funds and all that. And in that account, I also have a debit card associated with that account, so I could just fluently move from, my account to spendable money. Doesn't take too long for that process, but sometimes to sell some of the stocks or sell off from the fund, it can take days before that process is happening, and you can only even initiate it really during business hours. So I also have a bank account, and I linked my bank account to my Fidelity. That way I can just more seamlessly, have integration of the funds. That way, if I want to take some funds out and pull some of the funds and just buy some straight Bitcoin, or as I've done already, buy some ETFs, it's just a little bit more seamless and fluid. However, just to do a test to see how long it would take and what kind of fees would be associated, I sent $100 from my Fidelity account to my bank account. Now, and I did that from my Fidelity Bloom account, which is associated with my Fidelity account. Long story short. So I sent over $100, and as long as you send it before 4 o'clock, it will get there by the next business day. If you send it after, or as long as you send it by 4 o'clock, it will get there the same business day. If you send it after 4 o'clock, it will get there the next business day. So that's not too long, right? It's only, whatever. I did it at about 6 o'clock. It got there at 5 o'clock the next day. So let's just say it took 24 hours to get there. However, they also charged me 20% once it got there. So we're talking about a traditional financial system that is outdated, because after all, what are they doing, right? If you send money from one bank account to another using a traditional financial system, it may take 3 to 5 business days. That's how long it could actually take. And then there's typically fees associated. But why? What are they doing that's different than blockchain? Besides just being less efficient, they're doing the same thing. There's not a person, there's not a courier that's going to your bank to pick up the cash, to drive it to the other bank and deposit. That's not what's happening. The only thing that's truly happening is they're just adjusting the ledger. The same thing that blockchain does. That's what blockchain is. It's a ledger. Except for adjusting the ledger, in traditional finance can take days and a lot of fees to do so. If I wanted to send $100 of Bitcoin using the Lightning Network, it would get there instantly, and it would get there for free. Even if I didn't use the Lightning Network, it would only take a few dollars, depending on the network congestion of the day, and it wouldn't take more than 30 minutes for the transaction to take place. If I wanted to use a different type of crypto like XRP, XLM, Algorand, DGB, Litecoin, it could be there instantly and for free. Like literally, it could get there for less than a penny. So when people realize this, then they may fall back from traditional banking systems. Like one of the reasons why El Salvador decided to go Bitcoin as a legal tender is because 25% of their economy is based on remittance, people sending money back home from abroad. Well, to use the traditional financial methods to do this, the MoneyGrams, the Western Unions, they can charge up to 30 or 40% for those transactions. So that's 30 to 40% of the money being sent back that's not actually going into the economy because they're going into fees. So the idea is, well, now you can use the Lightning Network, send Bitcoin back, and then you could use that Bitcoin immediately if you need, and you can use it to purchase goods and services in the country. That keeps all of the money within the economy. So that's one of the reasons why banks do feel a conflict of interest. And that's one of the reasons why a lot of the regulators and media that is sponsored by banks have been so blah, ignoring or mocking crypto for so long, as they will continue to do until they have all their products and services ready to offer the people. And here's another example of that. FBI warns Americans against using unregistered crypto money transmitters. The FBI also included an official tool from FinCEN to let users look up if a company is registered as a money service business. Now, that sounds cool. That sounds like they're looking out for our better interests. And I guess it depends on how much you trust the bureaucracies like the FBI and how much you know about the true intentions or history of how they've been dealing with crypto and why. So Americans should not use crypto services from firms that are not registered as money service businessmen or businesses under federal law, the FBI said Thursday. The FBI also included an official tool. So they're giving you a tool so you can see that if they're, registered or if they're approved. So the U.S. Federal Bureau of Investigation has warned Americans against using unregistered crypto money transmitting services. Americans should avoid crypto services from firms that are not registered as MSBs under federal law and do not follow anti-money laundering rules, according to a Thursday statement from the FBI's Internet Crime Complaint. A few simple steps. So check this out. Here's what it really boils down to, y'all. A few simple steps can prevent unintentional use of non-compliant services, the FBI wrote in a release. For example, avoid cryptocurrency money transmitting services that do not collect Know Your Customer, or KYC, information from customers when required. In other words, what they're saying is do not use decentralized exchanges. They don't want you to use decentralized exchanges. Now, I'm a big advocate, as I've said many a time, study Bitcoin, learn Bitcoin, do your research on Bitcoin, because within that, you're also going to understand blockchain fundamentals and other different protocols, including DeFi and decentralized exchanges and wallets. Why do I say that? Because you don't need permission. You don't need to give your identity up for that. You don't have to wait for business hours. And typically, you'll be able to benefit more because you don't have a service provider that you have to pay for access to these things. When you have a centralized exchange, they're not going to pay you the same type of staking rewards as a decentralized exchange. Now, here's the caveat. When you use decentralized services, you do have to do your own research. You can't just try to go for the latest fly by night Johnny come lately offering you crazy interest rates or staking percentages. You have to do your research. You can't just jump on these multi-level marketing scams and Ponzi schemes. You're responsible for your own finances. That's why I only use trusted ones. And here's the thing, though. You can always do an audit for the code, or there are certified auditing agencies that will give you the information you need to make the decisions that you need to make. In other words, does the code run the way that it's being presented to you? You can find these type of things out for free. You just have to do a little bit of research or take the advice of people who you trust, and don't look for the newest, baddest, say, I'm going to give you 1,000% APR in 10 years and all that. Just don't fall for the okie doke. But what it really boils down to is they want you using the centralized services that they deemed okay. And typically that's because they're being paid by these services. Okay. Like, don't forget, FTX did KYC. They also paid the pockets of politicians on both sides. So they told you they were safe. And look what happened. See, there's a reason why it's a conflict of interest for you to be able to use these decentralized services, because once you understand how to use decentralized services without permission, without having to put your personal information, then your reliance on banks will start to lessen, and then you'll see more and more of this. Banks collapsing, as we've been seeing. This is why we haven't seen crypto and blockchain technology really pushed on the mainstream before the ETFs. Now that there's ETFs, now that there's centralized exchanges that are, putting ads on the TV and social media, they're starting to lessen on their FUD a little bit. Now that there's Bitcoin ETFs and some of the major market players in the game on Wall Street have products and services for you in the crypto realm, they're not going to FUD it as much, but they do want to discourage people from using decentralized services because it means you don't really need them. And to them, that is, detrimental to their bottom line and to their, long range success. This is why they're moving to get these central bank digital currencies ready. This is why banks and other financial institutions are starting to integrate blockchain and offer crypto exposure to clients, because they know over time people are going to gravitate there anyway. So they want you to gravitate to their services. That's what we have going on right now. Here's another thing going on right now, for those who don't know. And I suppose we could actually, let's just hear them say it. So this is the SEC. Now this story has to do with Ethereum ETFs, which right now I guess is kind of shaky if they'll be approved or not. I don't really think it needs to be approved. I think eventually they will, though. But I don't think it needs to for Ethereum to pump. I think Ethereum's going to do just fine with or without an ETF. Of course, Ethereum spot ETF will give more exposure. It will put it on the traditional financial radar of acceptance, which will make it a little bit more accessible for those who typically wouldn't invest in it or wouldn't know how, or wouldn't want to deal with self-custody themselves with wallets or whatnot, to make it tradable on, the stock market or whatnot on Wall Street. But let's just see what they have to say about it here. There you go.
Bitcoin outperformed Ethereum last year by more than 60%, but that could be a very different story in 2024. According to analysts at Standard Chartered, the odds of approval for ETH ETFs are actually even higher than Bitcoin ETFs were at this point, and could trigger a 70% rally by when they're approved in May. In a new note, Standard Chartered research head Jeff Kendrick writes, heading into the expected approval date on May 23, we expect ETH prices to track or outperform Bitcoin during the comparable period. But the SEC approving ETH ETFs is far from a sure thing. As SEC Commissioner Hester Peirce tells us, it's not exactly the same thing as Bitcoin ETFs, because the SEC back then was being sued to approve them. With ETH ETFs ahead of the May 23rd deadline, that's not the case.
We were in a place where we were going to have to move forward. And part of what made it so difficult to move forward, even with a court ruling, is that the rationale for denying these products in the past was very hard to put one's finger on. It was something that I had struggled with, and it seemed like the goalposts were moving over time as people came in with new data. The SEC seemed to want more, and so I think we saw that in how the ultimate analysis was done. But the staff of the commission has, they're obviously looking carefully at these markets, and we did have a correlation analysis, and I don't think anyone would deny that those markets, the futures markets and the spot markets, are correlated.
So while ETH ETF approvals are still somewhat of a coin flip, Commissioner Peirce tells us that they're not too dissimilar from what happened with Bitcoin ETFs getting approved. Both Ethereum and Bitcoin had futures trading already active on the Chicago Mercantile Exchange. So it is somewhat expected that it could follow the same process to approvals as Bitcoin ETFs once did. That said, Chair Gensler is throwing cold water on the idea that Bitcoin ETFs getting approved means anything for ETH ETFs.
I look at what we did this week as it's cabined to one non-security commodity called Bitcoin. Like we've had gold spot exchange traded products and silver exchange traded products in the past and approved in the past, this is cabined just to that one non-security commodity token.
The SEC's deadline to approve the two ETH ETF applications from ARK 21 Shares and Van Neck is May 23rd. Stay locked to Coinage.media for the latest.
So, I mean, now when it comes to Gary Gensler, you have to understand Gary Gensler is, he's a fudder. He's a mutter fudder. He's not in, like, he understands blockchain technology, but he really likes to dampen the excitement of the crypto market. It could be because he gets a lot of money from traditional finance and he owns millions in stocks, and maybe he sees the threat of, which I don't understand why he would. Maybe it's just because he's corrupt. But he doesn't, it seems like he doesn't want the competition of this new emerging crypto market and investment asset class. But it is what it is. So, in my opinion, there's no legal reason that I could see for them to deny an Ethereum ETF. I think it's just they want to put some water on the fire that has been burned and smoldering. As we know, we're entering into a crypto market that is about to go explode in prices. So, like I said, I don't believe that we need an ETF for every cryptocurrency. I understand the exposure will, make the prices go up, but I don't really think that we need it. But we'll probably see it by this year ends. I don't see why we won't see it, but nevertheless. So now let me show you this one right here. Another thing that is developing in the crypto market, and I've reported on this before, real world assets being tokenized. The tokenization of things like stocks, and in this case, treasury bills, other commodities, real estate. It's something that I'm looking forward to seeing because, with the $16.7 trillion potential coming into the crypto market, it's going to make a lot of different cryptos go bananas. It's also going to make it a lot easier to prove and acquire ownership of real world assets. And this is just one example of that. Or it's an example of the tokenization that is happening.
A Binance update in Nigeria, and WooX claims bragging rights over tokenized treasury bills. You're watching CoinDesk Daily. I'm your host, Jen Sanasi. The wife of Nadeem Anjarwalla, an executive who was caught in Binance's scuffle with Nigeria, has denied reports of his arrest in Kenya and subsequent extradition back to Nigeria. It was reported that Nigerian authorities found the executive in Kenya.
All right, I don't know if this is the same story or not. Let me see.
Initiative bridges a crucial gap between traditional financial securities and the dynamic world of cryptocurrency. Tokenization, especially involving bank-grade assets like U.S. Treasuries, has become popular, partly in response to interest rate increases and now dovetailing with the current crypto bull run. Last year, crypto investment platform Finblock said it was planning to offer retail users access to tokenized T-bills. And Thailand has decided to block unauthorized crypto platforms to increase.
So you see the trend that is happening. And I reported on this before. BlackRock is looking to tokenize real estate and other real world assets. We're going to see real world assets be a niche in the cryptocurrency market that is probably going to do very well. Like the idea, you know, like some of y'all know, I am invested in Propy, which is an Ethereum based coin or token that deals with real estate. They already have a platform. They buy and sell. They sell homes on their platform. They buy homes on their platform, tokenized as NFTs, essentially minted NFT addresses. It's something that you're going to see because it's, you know, you can't counterfeit a deed that is on the blockchain, and it's an easier process. You know, it makes the buying easier and cheaper, and I believe that it's going to be a big thing. And here what we're seeing is, you know, it's going to go further than just real estate. It's going to go into different commodities. There are already tokenized gold. Pax, Perth Mint, they have tokenized gold. I think that market will grow, especially since gold is going up. We're going to see real world assets. We're going to see stocks tokenized. We're going to see tokenized stocks, index funds, etc. This is where we're going. This is in part why the crypto market is probably going to explode like never before. Last bull cycle was parabolic, never seen before. This one is going to be that on steroids. So WooX is claiming bragging rights for being the first cryptocurrency exchange to offer retail customers exposure to tokenized U.S. Treasury bills. There it is. The yield-bearing product unveiled Monday, called RWA Earn Vaults as real-world assets, has been built in partnership with London-based institutional tokenization platform Open Trade. So we're going to continue to see the different collaborations of real-world assets, of different things that could be tokenized on the blockchain. So this is another reason why traditional finance, they're kind of pushing back from some of these things, only because they understand until they have their products and services, it's going to be a conflict of interest, and they may lose some of their dominance in the financial market. This is another reason why I believe the FBI is telling you, hey, don't deal with these decentralized exchanges. Don't deal with these decentralized protocols. Only deal with those who have got the stamp of approval from us, like the Coinbase, etc. Because Coinbase is already in the pockets of Wall Street. They've already got the green light, even though they still face some of their scrutiny and they still face different lawsuits because the traditional financial markets, like banks, institutions like banks, still feel some type of way about the fact that you can stake coins, you can borrow, you can lend, you can make money the same way they do without using them. You can get higher APRs, higher rates of return. Remember, banks will give you typically a couple percent at the most. An online bank might give you a few percent just because they don't have the overhead. But most brick and mortar banks, they're only going to give you 1/4 or 0.5%. Just think about how much you make keeping your money in a savings account. And then compare that to inflation. And when you do the comparison, you'll see that you're actually losing money holding your money in a savings account. Not because the amount of money is going down, but because inflation and cost of living is going up, and it can't compete with that cost of living increase. So your 1/4%, your 0.5% is not going to compete with inflation. You're going to lose purchasing power. We have seen this over the years. There's a reason why bank or burgers that used to cost 5 cents when my grandpa was around now costs $10. It's not because it's more expensive to make burgers. It's not because it's more expensive for homes to be built. It's because the dollar isn't worth as much. So when you have these decentralized protocols in which you can hold your money even in stable coins and get 6, 7, 8, 10%, well, where would you keep your money? Would you keep it in the bank, or would you keep it somewhere where you could stake it for 10%? When you can borrow against your collateral assets, when you could borrow against your own assets in a collateral debt position, which you can do on the blockchain, and you don't need permission, you don't need KYC, you could borrow 80%, you could put up 10,000 of collateral and borrow 8,000 against it. No payment schedule. APR much cheaper than the bank will probably give you. Then like what choices would you make if you have these choices? If you can put your money in a lending pool to be loaned out at a higher percentage. Remember, this is how banks make money. They lend your money out. They lend our money out. The difference on doing on DeFi is you don't have to worry about not being paid back, because everyone who borrows puts up collateral, so your money is 100% safe. You don't have to worry about it not being paid back. You can take it out anytime you want. But in the meantime, you can get percentages that banks charge when they loan our money out. So banks loan our money out at extraordinary fees, up to 30% if you have bad credit for your credit card, 5 or 6% if you're doing a mortgage, maybe 7 to 12% if you're doing an auto loan. That's how much money they're making off of our money, and then they will only give us 1/4 to 0.5% for allowing us to do that with our money. So when people compare these kind of things, they're probably going to go the route of being able to do it on their own without permission and reap better benefits. This is why billionaires like Michael Saylor says only poor people keep fiat currency as a store of value. Rich people use assets. That's how they store their wealth. Assets. So now with technology, especially with this blockchain, we're able to make some of the same moves that have kept billionaires passively making income. So of course, we're not going to have the same results if we don't have the same amount of money, but per scale, it's the same. We can now leverage technology to build wealth on our own. This is seen as, if nothing else, a conflict of interest to traditional finance. Anyway, I didn't want to take too long, y'all. Got to get going. It's Monday. Got to move around a little bit. Thanks for watching. Make sure you guys like, subscribe if you haven't already. Fill up the comment section with comments and questions. You can hit me up at CryptTalkPodcast@gmail.com. You can also follow on Twitter at CryptTalkP, and you can join Blockchain Crypto Gang on Facebook. Thanks for your time, y'all. Peace.